Okay, the second topic of this chapter is conceptual framework, which is described as an accounting constitution. You know the meaning of constitution, right? Which is the law of the laws. Also, I also think conceptual framework is the spirit of financial accounting. Okay, it provides guideline for the standard setters to provide high quality accounting standards. In the conceptual framework, actually, you just need to know the three answers from the three questions. One is why accounting. In other words, this question asks what's the purpose or objective of financial accounting. The next is what we should report. And the last is the methodology. How? Okay. Yeah, let's take a look at this flow chart. Okay. This flow chart starts from the objective, which define the objective of financial accounting. In the prior slides, we talk about the primary objective of financial accounting is to provide investors and the creditors useful information for decision making. Right? So that's the foundation of financial accounting. First, we should clearly know what's the objective of accounting. Okay? The next is what information is considered useful, right? And what we should report. So the elements actually includes the elements that are reported in the financial statements. Yeah, I will introduce the elements in detail later, but here I can tell you the elements includes the assets, liabilities, and stockholder equity. That's three elements in the balance sheet. Okay. Yeah. So this answers the question why, and the elements answer the question of what. Okay. Also, what information is considered useful, you should also answer what's the characteristic of useful information. This section also answer what, but just what the characteristic of useful information. Okay. And in the financial statement, we will include all the elements that provide useful information for the financial statement users. Right? For example, assets, liabilities, stockholders' equity provide financial position information for the financial statement users. They are useful, so we should include in the financial statements. Right? Next, what's the quality of information is considered useful? Right? There are two basic quality of useful information. Here I can introduce first. One is relevant. The information must be relevant to be useful. The next is reliable. Some books use faithful representation, but they are the same thing. These two are two fundamental quality of useful information. Okay, to improve the usefulness of information, we just improve either of them. Yeah, we can improve the usefulness of information by increasing the relevance or increase the reliability of the information. Okay, but here we also encounter some challenges that is constraint. Okay, just like what we learn in economics, right? We always have trade-off. And so here, we cannot increase the usefulness of information unlimitedly. There's also constraint what's the constraint? Actually, is the cost. Okay, any information will incur costs. Okay, so we only report the information which has greater benefits than the cost. Okay, so that's the constraint. That means when we include the information or improve the usefulness of information, we must consider the cost. If the information is too costly, we may not report it. Okay, for example, the CEO's personal private assets, okay, may be relevant to the investors and the creditors, but we do not report it. Why? Because this will be a violation, right? Violation of other laws. The cost will be higher. Yeah. So there are a lot of examples I will introduce later on. Okay. Yeah. So that's the second question. What? The last but not least is how. Methodology. That is recognition and the measurement concepts. Okay, so we are going to use this methodology to measure the elements and report in the financial statements. Okay, so that's the conceptual framework. We will find the financial statement is determined by the methodology, by the elements we include, by the quality of information. But these three are all determined by the objective we set. Okay. Yeah, so that's the conceptual framework. As long as we do not change the objective of financial accounting, all other parts in the framework is to improve the usefulness of financial information. That's the conceptual framework. Yeah, so here it says the conceptual framework provide guidance to standard setters develop high quality standards. Next, let me introduce the first one, objective. Next, let's break down each part of the conceptual framework and discuss them individually. The first one is objective. I have already talked about this, right? The objective of financial accounting is to provide useful information for investors and the creditors, who are the primary users of financial statements. The quantity or qualitative characteristic and constraint of information. If we break down the qualitative characteristics, we can have this flow chart. Okay, first, the qualitative characteristic of financial information is useful. But what information is considered useful? Yeah, the two fundamental quality is relevance, reliability, reliable information. Okay, and each fundamental quality also can be broken down into three. Relevance and faithful representation each can be broken down. Relevance and faithful representation or reliability can also be broken down into three components. So the information to be relevant, it must have predictive value, confirmative value, it must be material, okay? And the faithful representation has three components. Information to be reliable or faithful representation, it must be complete, must be neutral and free from error. Okay. Yeah. And also, besides the two fundamental quality of useful information, these are enhancing quality of useful information. They are comparability, verifiability, timeliness, and understandability. Okay. And why we think cost is a constraint, because in financial accounting, usually we cannot just increase relevance while we increase reliability. In most cases, is when we increase relevance, the reliability decrease, or when we increase reliability, the relevance reduced. So there's always a trade-off. As I mentioned, all the information will incur cost. We should consider the cost of information. We only report information that benefits exceed costs. Okay, let's try this multiple choice question. Which of the following is not a component of relevance as defined in the conceptual framework? Right? Yeah, answer is A, because free from error is the component of faithful representation. All other three are components of relevance. Next, which one is not a component of faithful representation? Yeah, answer is understandability. Yeah, understandability is neither a component of faithful representation nor the relevance. It is an enhancing quality of useful information. Okay. The next one is elements. Yeah, what elements should be reported in the financial statements? So here we have a list of elements. The first three I mentioned, they are elements of balance sheet. Okay, these three elements, they report the company's financial position. Okay, and investment by owners or distribution by owners, these two are for the other different type of business. Okay, like sole proprietorship or partnership. Okay, this one is commonly used for corporations. Okay, yeah, and next one is comprehensive income. I will talk about this in the following chapters. Okay, the following four: revenue, expenses, gains and losses, are components of income statement. Yeah, they together report the financial performance of a corporation. Okay. And here I didn't mention accounts, right? But actually we know each element will be reported by different accounts. Okay. Yeah. The reason is because different assets have different characteristics. For example, have different liquidity, right? Different in different format, right? So we report assets into different accounts. The accounts like cash, inventory, right? Accounts receivable, long-term assets, some other long-term assets, so on and so forth. Okay, for each element we can break down into different accounts. Yeah, the reason is when we break down into different accounts, this provide more useful information to the investors and creditors. Okay, yeah, the investor or creditors not only want to know the amount of assets, they also want to know what's the components of the assets, what's the amount of current assets, what's the amount of long-term assets. Yeah. So this is the elements we reported in the financial statements. There are 4 basic assumptions underlying US GAAP. You may not notice them if we do not mention in the conceptual framework. The first one is economic entity. This assumption states that a business is considered as a separate and distinct entity from its owners or any other entities. Okay, for example, if you buy the stock of Alphabet, you are the owner, right, the shareholder of Alphabet or Google. And if you buy a car, that's for the personal use, right? This transaction is your transaction, not Alphabet. Okay? Yeah, so if Alphabet buy a vehicle for the firm's operating purpose, this purchase is also separate from the owners. So that's the economic entity assumption. So this actually defines the boundary of the business. Also, what transaction we should report it on behalf of business. The next is going concern assumption. Yeah. We know all the business finally will fail. Okay, some business may last only a few months, some may last a few years or a few decades. Some business may last hundreds or even over 1,000 years, but no business can last forever, right? But as long as the business is in operating, we assume it has a limited lifespan. This assumption is very important because if the company is going to fail or file bankruptcy, the book value of assets and liability will become meaningless instantly. When some companies have high likelihood of bankruptcy, we still apply the going concern assumption. Okay, unless we have the solid evidence the company is going to liquidate all its assets and pay off the debt. Okay, then the book value will be replaced by the liquidating value. The next assumption is periodicity assumption. We know the business is an ongoing process. It has a transaction continuously, internally or externally. But for reporting purpose, we manually divide the life of business into different time periods. That's for financial reporting purpose. For example, we divide the company's life into years or further into quarters, right? Because the company should report their periodic financial statements to the capital providers. But the business operation never stops, right? Yeah, so that's the assumption. The last one is monetary units. Yeah, all the financial statements are reported in US dollars in the United States. Okay, and we do not account for inflation in the financial reporting. So these are 4 basic assumptions. The next topic in the conceptual framework is measurement. As I said, this is to answer how methodologies. It includes 3 parts. One is recognition, which refers to the process of admitting information into the financial statements. So recognition includes revenue, expense, assets, liabilities, recognition. So for the recognition, we must define what is assets, what is liability, what is revenue, what expenses. When the transaction or when the information meet the definition, we should recognize that information. Basically to make journal entries to record this transaction in a certain accounts. Okay. The definition must be clear, so the transaction will be recorded in the right accounts. The next is measurement. The information must be measurable. So it is the process of associating numerical amount with elements. Finally, we need to use the numbers to record the transaction. Disclose means how to report the information, in what format, communicate the information to the financial statement users. All three are about methodologies. They answer the question how. Use revenue and expense recognition as an example. We should clearly define the revenue. So here the revenue is defined as inflow of assets or settlement of liabilities resulting from providing a product or service to the customer. Okay, so any information or transaction that meet such definition should record the revenue. Revenue recognition also guided by the realization principle. There are two criteria for revenue recognition. Okay, one is earnings process is judged to be complete or virtually complete. The next is reasonable certainty as to the collectability of the assets to be received, usually cash. Okay, and here we mention these two realization principle or criteria because in reality we may encounter many complicated revenue recognition circumstances. The revenue recognition will be determined case by case. In this class, you just learn the principle or criteria of revenue recognition. All the examples, cases, problems, and exams, the revenue recognition principles are met. In the simple world, usually when we recognize revenue is the moment when the goods and service are transferred to the customer. It's not when the cash received from customers. So revenue recognition also reflect the accrual accounting. Now we know revenue is an element of income statement. Another element is expense. Their difference is earnings or profits, right? So to make the profits information more useful, revenue and expense must be matched. If the revenue and expense are not matched, their difference, net income, is not useful. So for example, when a dealer sells a car, the car may price at $40,000. Only he deducted the cost of this car, for example, $20,000. Then the $20,000 profit is meaningful, right? Yeah, it should be matched. The revenue is from sales of this car. Also, this is the cost of the car being sold. They must be matched, and then their difference, the profits, or the margin is a useful information. And there are different ways to match the expense to the revenue. The first one is cause and effect relationship. Okay, yeah, just like when Walmart sell the inventory, right? It recognizes the sales price of the inventory as revenue. At the same time, the cost of inventory will be recorded as expense. This relation between expense and revenue is cause and effect. This is like the two sides of a coin. The selling price of inventory is revenue, while the purchase of the inventory is the cost. You cannot split them from each other. The next one is associate an expense with revenue in a specific time period. Yeah. So this expense also refers to the period expense. For example, admin expense, administration expense, right? Research and development expense, right? So this expense has no direct relation with the revenue generation. Yeah, but they are incurred in a period when the revenues are recognized. So this is also a match approach. Okay. The third one is systematic and rational allocation. This is based on the reasonable assumption regarding the usage. For example, depreciation. We just assume the company buy a computer worth $10,000. It can be used for 10 years and the residual value is zero, right? It makes sense. Each year, the company should recognize $1,000 expense for depreciation. So that's the systematic and rational allocation, just based on the calculation. The actual use of this computer may be different from the numbers. The first approach in the period of incurred without regard to the related revenue. For example, interest expense. Right? Interest expense is incurred from debt, right? It has no relation with the revenue. So we record interest expense during the period when the revenue is recognized. If the company report quarterly income statement, so it includes the revenue earned in that quarter, so we also recognize the interest expense incurred during that quarter. Measurements. The US GAAP currently employs a mixed attribute accounting. In other words, we are allowed to use 5 different methods or measurements to report the elements of financial statements or for financial reporting. Okay. The first one is historical cost. Second one, an RV. Third one, current cost, also called replacement cost. The cost to reproduce or to replace the current assets or liabilities. Present value of future cash flows. So this one I will introduce more in the time value of money. The last one, but not least, is fair value, which represents market value. So mixed attribute accounting means we use different measurements for financial reporting to maximize the usefulness of information. Historical cost, which is very commonly used in financial reporting for both assets and liabilities. And the historical cost represents the original transaction value. It's amount the company paid or received in the exchange transactions. For assets, when a company acquires an asset, it must make a payment for this asset, right? And the amount of the payment is the historical cost. Well, the liability is similar. When the company borrow money from bank or issue debt in the debt market, the amount of payment or cash received is the historical value of the liabilities. Both historical costs of liability and assets are subject to the change. Okay, when time lapse, both assets and liabilities will be adjusted, and the adjustment we call depreciation or amortization. The reason is very simple, because when the asset is used, it loses value, right? So we should write down the value. And also when the liability is being paid off periodically, so the value of liability should be written down because it is partially paid off. So these are adjustment to the historical costs. Net realizable value, which is defined as the estimate selling price in the ordinary course of business, less reasonably predictable cost of completion, disposal, and transportation. It is not the estimate selling price. You should also subtract the cost of completion, disposal, and transportation. For example, a company has the inventory estimate selling price is $10,000, but the inventory is not complete. So it may incur $1,000 to complete and another $1,000 for disposal or transportation. So the net realizable value is not 10,000, it is 8,000. So that's net realizable value. We will use it later in the valuation of inventory. In fair value, also called market value, which is very commonly used to measure assets and liabilities, particularly financial assets, financial liabilities. Because these assets and the liabilities are actively traded in the second stock market or debt market, so there is a market value available. So the company can use this information to measure their liabilities and assets. So there are three approaches. One is market approach, as what I mentioned, just based on the market information. The other two are income or cost approach. These two both are estimate. Okay, income approach is very similar to the one I just introduced there, the present value of the future cash flows, and cost is very similar to the replacement cost. Okay, and these three measures depends on their reliabilities can be classified into three hierarchy. So in this table, we can see for the fair market value approach, we have three levels in the order of reliability. So level 1 has highest reliability, while level 3 has the lowest liabilities. So level 1 is based on the quoted market price. Level 2 is based on the quoted price of the similar assets. Yeah, this usually refers to the cost approach. The last one is not observable, but just predictions, right? The present value of the future cash flows. So it is least reliable measurement for fair value. This is a 10K form by Alphabet or Google. You can see the summary of significant accounting policies. On this page, if I scroll down, you will see that it discloses the fair value measure. You can also see the level 1, level 2, and level 3, which are consistent with the fair value measure I just mentioned in the PowerPoint. Let me introduce the full disclosure principle. This principle requires that the financial reports should include any information that could affect the decision made by the external users. In a typical financial statements or annual reports, we not only see the numbers, tables, but also see a lot of textual information. This information is important for the external users. We should also include the comments, the notes, and the supplemental schedule and tables. Let me show you where you can find this extra information in the annual reports of Alphabet. Again, we go to the 10K form. In addition to the financial statement, the company should also provide the notes. Yeah. So in the income statement, we have the top line revenue. But if we want to learn the details of revenue, we can go to the notes to the revenue. So in the notes, Google break down its total revenue into different segments or different sources. So that's an example of the notes to the financial statements. Okay. And also in the accounting policies, the company also report the nature of operation and any related information that matters to the external users. Without this information, the financial statement user's decision may be affected. That's why the company should disclose all the relevant information.